What's up, everybody? Welcome back to Trades and Gains. We're live currently over at Free Wi-Fi Radio, and this video is, as always, powered by Investor Central Club, the best options flow software out there. If you use the code SUPERMAX20, you can get 20% off your first month at investorcentralclub.com. But we have some bigger fish to fry and some fatter women to fry. It's FOMC week, which means Jerome Powell is about to walk on stage, clear his throat, and tell the White House, Wall Street, and every over-leveraged trader on X the same thing they heard last time. We're holding rates. Relax. He'll do that first. He'll go, good afternoon. Based on the economic state. Anyways, when he says that, the irony is nobody ever relaxes. Markets are acting like this meeting is either a fire drill or the beginning of a rate hike apocalypse, even though the odds of a rate cut are under 3% and the odds of a hike are basically non-existent. Today, we're going to go ahead and break down what the Fed is actually doing, why higher for longer just got uncomfortable, who wins and who loses, and why this might be the most awkward FOMC meeting of the year. So let's go ahead, dive in, and get into it. And if you haven't already, make sure you go ahead, smash that subscribe button. It really helps the channel out. We just hit 938. Our next goal is to break 1,000. Will you be one of the 62 to help us get there? So let's go ahead and set the table. This is where rates are actually. So facts before vibes, that is the motto of this channel. Fed fund rate is at 3.5% to 3.75%. 3 cuts have already happened in late 2025. Inflation, it's cooling, but still above the target, right? The labor market, it's softening like the blue chews finally wearing off, but it's not breaking, so it could still get up at some point. The translation of this in plain English is the Fed already did the easy part, all right? Now they're in a no-win zone. If they cut too early, inflation goes ahead and roars back like a lion. If they hold for too long, however, the labor market is going to start to show its crack, like when that plumber comes over to fix your sink and bends over. And a rate hike, well, that's what we like to just call political napalm, baby, because that would set everything on fire. And let's talk about full-blown panic at that point. So Powell's strategy is simple. Say nothing, move nothing, and everyone gets offended equally. Because honestly, if everyone's offended, then it's like, you're not really pointing anyone out, So listen closely to the language Fed officials keep using. Policy is in a good place. We have flexibility, meeting by meeting. That's basically, those 3 phrases are Fed speak for stop asking us to save you at this point. This isn't a pause because everything is perfect. It's a pause because, well, inflation won't die, jobs aren't collapsing, and tariffs are back in the chat. The Fed, they don't want optionality, they want time, because time, like our options plays on this channel, are our best friend at the end of the day. So let's go ahead and break this down into some real scenarios, and we can turn off that galaxy gas nozzle and hop into reality. Oh, there's reality. Oh, there goes gravity. Palms are sweaty, knees weak, arms are heavy. There's vomit on his sweater already. Mom's spaghetti. So let's talk about scenario 1, the base case. Hold plus dovish pause, which is most likely, by the way. So what is going to happen here? Well, rates, they'll be unchanged, kind of like your toddler's diaper. Powell says inflation progress is quote unquote encouraging. There's no commitment to cuts in the future, and the markets will breathe briefly. Now, speaking of markets, the reaction on the market side would be equities would get a modest bounce, bonds will move sideways, crypto, we're going to see some knee-jerking volatility, and the dollar is going to look slightly weaker. Now, who wins out of this? Well, large cap tech, quality growth, and AI infrastructure names. Who are the losers in this? Well, rate sensitive small caps, speculative crypto, over levered consumers, and this is the nothing broke, so don't even touch it and let's act like it doesn't exist, you know, like our adopted child scenario. Scenario number 2, hold plus a hawkish tilt. This is underappreciated risk. This is where Powell leans into neutral rates may be higher than we thought. That's code for, well, stop expecting free money, you pores, okay? Market reaction, stocks are gonna fade. Yields, well, they creep higher. Gold and silver catch a bid, and crypto, well, its knees start to wobble off. Now, who wins in this? Energy, defense, metals, and value stocks. And who loses? Those high multiple tech companies, unprofitable growth companies, and anything priced for rate cuts by summer, aka IWM. This is your early slap in the face. And then scenario 3, we have a hawkish surprise. And this is where we hear about hike talk. This is low probability, but it also has high damage. Nobody expects it, which is exactly why it would hurt. You know, like a kick in the balls you didn't see coming. Market reaction to this, equities, they sell hard. The dollar spikes, crypto gets smoked, and gold rips. This would tell markets neutral isn't 2%, deal with it. And Powell, well, knows this would be chaos, which is why it's most unlikely, right? So let's not pretend politics aren't involved in this either, by the way. Trump, he wants cuts. He complains about it on Truth Social and everything the entire day. That man is like a dog with a bone, but he has a lot of bones in his mouth. DOJ drama is still surrounding Powell. Fed chair replacement is incoming. And by the way, part of becoming the Fed chair is Trump said you have to be willing to cut rates almost immediately. Supreme Court noise, well, it's in the background. And the Fed's response here is going to be to, well, dig in harder. Nothing makes a central bank more stubborn than public threats, legal pressure, or Truth Social posts at 2 a.m. So if you're betting on the Fed blinking first, yeah, good luck. They're willing to die, okay? Now, what does this mean for consumers? Because this isn't just a trader story at the end of the day. For consumers, mortgages are going to stay high. Credit cards, well, they're going to stay brutal. Auto loans, they're going to be even more painful. And rent, unfortunately, it does not magically just fall. But guess what? Saving rates, they're going to remain attractive. CDs are still going to be in play, or are going to still pay. And cash isn't trash, and that is for once. The Fed is basically saying, spend less, save more, and then adjust. The winners in this scenario, by the way, AI infrastructure, CoreWeave, NVIDIA ecosystems, think about that. Energy and power, defense, metals, gold, silver, and copper. Okay? Why? Because, well, uncertainty equals hard assets plus infrastructure for the future. The losers here, that's going to be the over-levered consumers, speculative growth, meme stocks, and crypto during rate uncertainty. High rates expose weak balance sheets. Period. Clock that T, sis. So here's the punchline. The Fed isn't cutting because it can't. It isn't hiking because it shouldn't. We're in the awkward middle, where money is no longer free, but the economy hasn't necessarily cracked yet. And until something breaks, this is the regime. Not exciting, not comforting, but very tradable if you understand it. See you after Powell says, well, absolutely nothing, because his press conference is where we will see real fireworks, and markets, guess what? They're still going to lose their minds no matter what is said tomorrow. This is Max Pitts with Trades and Gains. I hope to see you guys in the next video. Hope you join us for our FOMC stream tomorrow, and I will, well, talk to you in the next one. Like, subscribe, comment, leave your hottest take below. Tell me, are you bullish, bearish? How are you feeling going in tomorrow? Have a great day. Love you. Good night, America.